welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX-listed universe. I'm your host, Olivia Grace Curran. Well, US markets tumbled on Tuesday with a gloomy consumer confidence report and uncertainty surrounding US President Donald Trump's economic policies prompting a sell-off. The S&P 500 and Nasdaq notching their fourth consecutive session in the red, while the Dow ended modestly higher. The SIBO Market Volatility Index spiked to its highest level since January 27. The tech-heavy Nasdaq hit a 6-week low. Nvidia dropped around 2% ahead of the chipmaker's much-anticipated quarterly earnings report, expected after the bell on Wednesday, pulling the Philadelphia Semiconductor Index down. Meta shares ended in the red for the sixth consecutive session, the stock's longest losing streak since December 2023. Eli Lilly rose after the drug maker said it has begun selling higher doses of its weight loss drug Zepbound in vials in the US at a discount to the injector pen versions. US listed shares of Li Auto jumped more than 13% after the company unveiled its first electric SUV. Shares of insurance customer acquisition platform Media Alpha plunged as much as 17%. Zoom Communications slid following its disappointing annual revenue forecast. Crypto stocks fell, tracking Bitcoin weakness, Coinbase sliding around 6%, MicroStrategy down more than 11%. Australian Treasurer Jim Chalmers has met with his US counterpart Scott Bessent in Washington, seeking an exemption on 25% tariffs on imports of steel and aluminium announced by President Donald Trump last month. Speaking at the US Superannuation Investment Summit attended by Chalmers on Tuesday, Bessent said that there is very little friction between the US and Australia, noting that there is a great deal of friction with other trading partners. Trump's blanket 25% levy on all steel and aluminium imports are set to come into force from March 12. Australia is not yet exempt from the tariffs. Bessent also argued on Tuesday that the US economy is more fragile under the surface than economic metrics suggest, citing interest rate volatility, sticky inflation and job growth focused on the government sector. It follows a weak read on US consumer confidence, the index dipping to 98.3 in February, the lowest reading since June. Meanwhile, US Treasury yields dropped sharply, the 10-year hitting its lowest in 10 weeks. 2-year yields slipping to 4.1%. The US Treasury sold $70 billion worth of 5-year notes on Tuesday. Meanwhile, the US dollar retreated, extending declines after that soft reading on US consumer confidence. Optimism for more spending in Germany helped lift the euro, while the Aussie is currently sitting around 63.5 US cents. Bitcoin has taken a plunge. It's now sitting just shy of 88,000 US dollars, its lowest since November 18. Oil prices have dipped to a 2-month low on weak economic news out of the US and Germany, and fears output may increase. Gold has dropped to its lowest level in over a week, spot gold down around 1.42%. While copper prices have fallen after President Donald Trump reiterated his import tariff plans for Canada and Mexico. Well, for more on what's moving the US markets, I caught up with Tim Richardson from Pengana earlier.
Well, this is a continuation of the trend that we've seen since markets reached a peak last Wednesday, which now seems quite a long time ago. Rather than pointing to a single thing, it's a number of issues that are all interconnected. It's tariffs, it's persistent inflation, and of course the weakness in consumer sentiment, which we saw in the data overnight. But what we have seen since the start of the year is the US market, despite its strong start in the aftermath of the presidential election, it's actually underperformed pretty much all the major markets, all the European bourses, but also Hong Kong, most of Latin America, including even Mexico, which is threatened by tariffs.
And so, just how concerning is that economic data, even the one that we did get overnight and from last week as well?
The underlying economy in the United States, is reasonably solid. It's not a moment to necessarily go into panic mode. I wouldn't have thought. You saw that in the December round of quarterly earnings reports that we've seen over the last few weeks. They were generally, by and large, pretty solid. And that was reflective in some upwards share price movement. But having said that, there are signs that the US economy, the momentum behind it is starting to slow a bit. Now, a big part of that is the sticky inflation that we're still seeing. That has reduced the expectations of interest rate cuts this year in the States. What interest rate cuts we're likely to get is probably already reflected in equity market pricing at the moment. You're seeing some pretty weak manufacturing data, perhaps reflecting rising input costs, and that's perhaps leading into an increasing number of job losses, which is of course impacting consumer confidence that you saw in the data overnight. We saw that in a 5% fall in house sales in January in the States, and for the first time in 2 years, the activity in the service sectors actually decreased in the last month, and all of that is being clearly noticed in the spending patterns of the middle and lower income demographics. You saw that with Walmart's forward earnings guidance, which a lot of investors found a bit disappointing just a couple of weeks ago.
And of course, with the uncertainty surrounding the tariffs still, do you think until that is ironed out, there won't necessarily be a smooth path forward at the moment for markets?
I think markets are certainly going to be volatile, yeah. The thing with President Trump is he likes to keep everybody guessing. He's well known for that. But the problem with that is that uncertainty acts as a brake on business investment, and that can slow down earnings growth and slow down GDP growth. And you're starting to see a bit of that reflected in share price market volatility. And that particularly impacts those US-based companies that depend on exports. They now face the prospect of retaliatory tariffs, and in some cases overseas markets looking to secure their own supply chains of critical goods.
Now, we also saw the VIX hit its highest since January 22nd, I believe.
That's right.
So, how much longer do you expect that market, uncertainty and fear to be around?
I think all of these factors are closely intertwined. What you've seen is after some upward movement in the US dollar in the aftermath of the US presidential election in early November, this year we've seen that pull back. The US dollar has actually underperformed against pretty much all the major currencies. As you say, we've seen a significant fall in the DXY, the basket of currencies of America's trading partners. That's down about 3.4% since the middle of Jan, when it hit a bit of a peak. Partly that's a reflection of the expectation of lower interest rates. Paradoxically, at the same time, you've got this latent inflation in the US economy. But there's also some external factors. The Japanese yen has appreciated 5% against the dollar in that period of time. That's partly reflecting the strength of the Japanese economy, and it's also a recognition that Japan's government won't stand in the way of the Bank of Japan continuing to raise interest rates as its inflation starts to recover.
We've also seen Bitcoin hitting its lowest since November, when Trump did win that presidential election. Is that really a gauge as to how things are going with that uncertainty and that risk off?
Well, Bitcoin was originally conceived as a store of value beyond the reach of governments, and there were analogies drawn with the history of gold investment. But what we've actually learned over the last couple of years as it's grown in popularity is it's a very much a speculative asset. When animal spirits are on the up, the Bitcoin price rises, and when you see equity markets pull back, as we have done over the last week, it's perhaps not too much of a surprise that you see the interest in crypto fall away again.
So how should investors be reacting to elevated levels of market uncertainty?
Well, I think there are opportunities with the weaker US dollar in terms of non-US dollar assets have the chance to outperform, particularly if Europe engages more in structural reform in the aftermath of the weekend's German election, and if Japan continues to focus on delivering shareholder value. And also there's the opportunity for US exporters to gain a price advantage with a weaker currency. But that does, of course, assume that tariffs don't raise their input costs or act as a barrier to their export markets. But having said that, I think a diversified portfolio of high quality growth stocks has a role to play in long-term investors' investment strategies. But in particular, it's worth investors looking for those businesses with a sustainable competitive advantage that's likely to deliver the pricing power that'll give them a bit of protection in the event that tariffs become that much more of a problem, and particularly looking at those companies that align to those big long-term secular growth trends such as onshoring, AI, medical discovery, that are perhaps likely to outperform businesses whose earnings growth depends on spending by lower to mid-level households.
Now, US Treasury Secretary Scott Bessent has been speaking in Washington at that super conference. He did say in a speech that Australia and the US, they have like little friction as trading partners compared to other countries. Does that sound like good news for Australia when it comes to tariffs?
Potentially, yes. Australia's in a fortunate position strategically. Geography's been kind to it, and there's long-term strategic and defence arrangements that will always be in the back of policymakers' minds in Washington. And Australia is also in the position, in contrast to Canada, Mexico and most of the European Union, in that it doesn't run a trade surplus vis-a-vis the United States. So that, and also the relative size of the Australian economy, may well leave Oz underneath the radar.
And just before we go, getting one final check of the market before the trade gets underway. SPY futures are currently down 21 points. Well, that does it for this edition of The Global View. Stick around, the Open is coming up next.